The honor of introducing you to these great panelists. First, we have Tucker Kane, CFO of the Dodgers. Second, we have, we have Mitch Lasky, partner at Benchmark. We have Martin Matak, founder and CEO of Vert. We have Matt Higgins, founder and CEO of the RSE Ventures. And we have Bill Aulette, managing director of the Martin Trust Center. The panel is moderated by Peter Keating of ESPN. Yeah, let's give it up for him too.
Hey! Peter! That's very funny.
And it will run for 45 minutes with time at the end for Q&A. If you do have questions, please use the Guidebook app or Twitter and use the hashtag Sports Entrepreneurs. With that, I turn it over to Peter.
Thank you. Thank you all for coming, and thank you to our panelists. We just started with 7 rounds of applause. That is more than the total on several of the panels I have moderated in the past, so we're off to a great start. The subject of how a great idea becomes a billion-dollar business is something that could take up books, business school curricula. We're going to try to tell as much of that story as we can in the time that we have. And the first thing we're going to talk about is why sports. $1 billion, more than $1 billion, flowed from investors in venture capital to sports startups last year. And that amount has been growing at about 30% a year since about 2012. So what makes this a moment for so much VC money to be flowing into sports, as opposed to, say, medicine or environmental science or anything else? Matt, you've built many businesses in the private and public sector. In 2012, you co-founded RSE Ventures with a focus on sports and entertainment technology. Let's just start off, why sports? Why focus on sports?
I think a lot of it has to do with technology. I think the reason why you're seeing the rapid and steady increase in investment is all can be traced back to technology. If you think back to 2009 and the advent of MySpace and whatnot, the leagues were still uncomfortable with the idea that an athlete would actually communicate directly with a fan, one-to-one. It was still a focus on what are the liabilities that would be created by virtue of a athlete being connected directly with a fan. They might say something inartful or impolitic and so forth. Fast forward now, the entire paradigm has changed, right? That it's every league and every team is trying to pull back the curtain and connect the athlete with the fan. So I think the nexus of the paradigm shift is the introduction of technology that makes it possible to disseminate your content to anyone, anywhere, to fragment your content in all sorts of different ways that didn't exist before, and connect your brand with a fan or an athlete or a sponsor. So I think a lot of what's made it possible for investable capital to come in is that there's been a paradigm shift, that the teams that used to be way more traditional and maybe resistant to innovation have had to completely make a 180 in order to thrive in this industry. And as a result of that shift, money then can come in.
It makes it sound like there's a lot of different U's in there. There's teams, there's sponsors, there's consumer businesses, and then there's fans and athletes all connecting to each other in a giant web of lines, as opposed to teams selling game to fans, right? So let's talk a little bit about which sports and which areas. What are the, for lack of a better term, hot areas where money is going and why? Tucker, the Dodgers just ran last year an accelerator which attracted, I think, nearly 600 participants, right? People applying to the Dodgers to be one of the 10 finalists who you were going to fund, right? Did you see a pattern to the businesses that you guys chose as winners, or a pattern to where the smart ideas were coming from?
Well, I think first of all, we were pleasantly surprised with the volume of inbound interest and the diversity of it. One thing that was very clearly embodied in that application pool was the diversity of ideas, and I think Matt is exactly right. I think, as we think about it, really kind of ultimately starts at the fan level, the fans' interest in consuming our content in different ways and new ways, engaging with it around analytics, engaging with it through fantasy, all these different pieces that start at what the fan really wants. And I think the sports industry has kind of been chasing that tail a little bit, trying to keep up with the fan and put our content where the fans are. So as it relates to kind of the focus, I think we saw some really interesting companies in the youth space, which again kind of started with the fan down at the lowest levels and trying to bring them up through the ranks. Content delivery, whether it's virtual reality, augmented reality, all these different ways you distribute content, and then other pieces that kind of add on to it. Fantasy, how do you elevate engagement, analytics around fantasy, and all those pieces. So that's the kind of core areas where we saw some interesting activity and ended up focusing most of our time in the program.
So I think that both of those questions kind of link together in a way, right? So part of the easy answer to your first question, why sports, why $1 billion into sports recently, it's that it's been ridiculously underinvested historically, right? Venture capitalists typically shied well away from sports because there are a lot of structural reasons that made it not suitable to investment in the way we normally think of it.
Like what? Why, if I had $1 billion, why wouldn't I? Since sports are what people are spending money on, why would I find it hard to invest in sports?
In the old days, really, it was the kind of companies that were available for investment were selling to teams typically, or selling to leagues, and that level of customer concentration and that level of kind of almost regulatory environment to a certain extent is not suitable to the kind of breakout scalable businesses that we typically like to fund out of Silicon Valley. So I think that's part of the reason why. But it's exactly the insight that the fan has now come to the center of the conversation that I think has turned it into something investable finally in a way. And that is all the media businesses and a lot of the technology businesses are now really looking for those aggregations of audience that didn't exist before. And the ability now to micro-target and to reach those audiences in unique ways, whether through Twitter or Snapchat, whether through the Dodgers or the Miami Dolphins, has really changed the game in a lot of ways and has really made it a lot more interesting to the venture community.
So it wasn't as interesting to invest in a company, let's say, was making bats, but it is a lot more interesting and profitable to invest in new ways for a team to reach 80 million fans through Snapchat.
Correct.
I also might add, I think it all has to do with timing. So when it comes to anything, technology always prevails. You can't stop it, right? So how many students out here? Raise your hand. Yeah, so a lot of students, yay. So if I told you that my idea from a founder point of view was 20 years ago, would that be like, wow, I can't believe that? It's because 20 years ago, the technology wasn't there. So you have this great idea, and it won't leave your head, and it just totally starts developing over time. So to me, it's timing. Right now, you have all these crossroads of amazing things: analytics, wearables, social media. Everything mashes together, and for us, it's that perfect scenario.
Talk a little bit about wearable technology. I'll tell you when it crossed my radar. I want to make sure I have this number right. That Under Armour spent $560 million to acquire MyFitnessPal and Endomondo last year, which are two fitness trackers. Yeah. I was like, $500 million for fitness trackers. The technology really must be there to make this possible, but talk a little bit about when you had your idea and how it's translated into what you're doing today.
Yeah, I think your numbers, if you combine the other two companies that they acquired, is more like $820 million, so almost $1 billion that they did. So 20 years ago, I was coaching Little League basketball after college, and the epiphany was seeing a little kid jump, and they just bought a brand new pair of shoes. All they cared about was how high they jumped. And that's when I said, you know what, there's got to be a way to make that into a real-time device that can tell you how high you jump. So then fast forward when in early 2000s, you make a prototype, And it was really a fish finder on shoes. It was kind of funny. And don't travel in the airport with it because you'll get stopped right away. You can imagine that. It happened to me. And then in 2007, the iPhone comes out, and I got it. And we were making 3 different things. One was boxing gloves that tell you how hard you punch, and it was shoes that tell you how you jump, and it was golf clubs that tell you your swing speed, all in real time on a Nokia 810 at the time. And when iPhone did it, it's when I had that bigger epiphany of how it's all connected. How do you put this into broadcast? How do you connect it with social? And for me, it was the big aha moment.
Bill, is there such a thing in your experience as a typical entrepreneur? Is it usually someone with one great idea, or is it the kind of person who just keeps bubbling over with idea after idea through their career?
So I want to go back to the original thing you said and just put some, despite being an elite athlete myself, though people haven't recognized that yet, I look at entrepreneurship across all areas. There is nothing special about sports. Let me be clear. Everyone's special in their own snowflake and everything. But technology hits everything. And it's flowing into fintech, it's flowing into ed tech. It actually flowed into energy, and then it flowed back out again, as our friends know very well here from Silicon Valley. There is a kind of irrationality to what goes on, and it's market seeking new opportunities. The key word that was said right at the beginning is technology. Technology makes it an interesting investment because technology changes the game in a very short time period. This is Moore's law. It doubles the power of the chip within 18 months. So our friends here can put a small amount of money in, and they can see enormous benefits over a period of time. That's true of all industries. Does that mean when you said bats, no, bats is a good investment, Yankees, was investment in the Red Sox a good investment? Turns out it was a great investment. It wasn't a venture investment. It just takes a long time because there's no underlying technological law like Moore's law or Metcalfe's law pushing it along. So I think entrepreneurship is pervasive through everywhere in society today, and it's going to change everything. And it's going to change sports with the quantified self and the things we're talking about here. But to think that it's unique, it is not unique. And in fact, there are other problems and let me just talk about it. I'll call it the feces factor. I have someone in my hometown who moves crap from A to B and then from B to C. They make enormous amounts of money.
You mean literally?
Literally moving crap from A to B.
As opposed to working in an office where it's metaphorically true.
That person makes tons of money because nobody wants to do it. On the other hand, I have a son who wants to work for the Red Sox. How much do the Red Sox pay interns? Not very much. How many ski shops do you know that have made money? Not very much, because everybody wants to do it. So the challenge that we have in this industry right now is that everybody wants to be in sports. And you don't want to be in an industry that everybody thinks is attractive. You might not like moving crap from A to B and B to C, but you can make a lot of money doing that, and it makes a sustainable business model. So that we have to dampen down some of this enthusiasm here to understand you have to be even better in sports to make money in these opportunities because everybody wants to do it. Now, what was your question? I forgot your question.
Well, stay with that.
Well, just stay with them.
Stay with that for 1 minute. Stay with the feces problem for a minute. Keep digging at the feces for a minute.
I think crap is a great point because to take it a little bit further, that we see tons of ideas, especially in the last few years. They've become exponential. The difference between sport and innovation upon crap is that the person who's probably doing it has not been a fan of crap all their life, right? And that's what's driving them to get into this industry. Their idea is probably a opportunity to innovate upon an old industry where there's real profit and real opportunity at the end of that rainbow. Because so many people want to pursue sports because it's their passion, they may push an idea that really is just a feature or a novelty, or it's clever, but there's no business behind it. So I would see, presumably, more so than in other industries, but I see so many different ideas that are really nice, but just an attempt for an entrepreneur to make their hobby on Sunday their job on Monday.
Let me ask, Mitch, let me ask you.
There's a corollary to that, and that is that sports has been so backwards for so long. There's been so little innovation in the front office, on the field, everywhere, throughout, even in the media. That there is really a tremendous opportunity set if you can bring innovation to the table, because like you're not up against it's not like you're creating a new database and there's 50 years of database development behind you. I mean, there's not much innovation that's gone on in this field for a long time.
Well, the reason why
That's true for education. We can go to other industries.
Right.
But that means there is opportunity here. We just have to balance these things off against each other.
Yep.
And the other point to yours is there's a ton of money spent on sports.
Oh yeah.
Well, the reason why I created RSC with Steve Ross in 2012 is exactly that reason. That when you have sports teams that attract millions of people and they're incredibly passionate around it, everybody wants to be in that business, so you have the ability to choose from thousands of applications for an internship that pays $10 an hour, that can sometimes feed monopolistic behavior, right? That feeds high resistance to innovation, stuck in your own ways. And so I saw a tremendous arbitrage opportunity that if you can go ahead and take advantage of it and create the right culture, that you really could cherry pick some of those great ideas. So I partnered with somebody who's built their whole career on disrupting the status quo. So I don't want to say just because there is a lot of those ideas that really don't belong to be businesses that there isn't a tremendous arbitrage opportunity. But where you can get really hurt with sports and investing is if you don't have a precise filter. Yeah. Because you think, oh, that's a great idea, it'll appeal to millions when it's just a feature.
So if I'm hearing you right, sports is still a sector where investors can reap the rewards of companies that can generate monopolistic profits while helping them adjust their behavior and toward innovation and a little more creativity as opposed to being hidebound and traditional.
Yeah, I think everything being identified here really pushes the need to be laser focused on what problems are being solved by this technology, by these thousands of applications that we all see. Being laser focused on, it can't just be a fan, it can't be just a nice idea. It's got to have a real use case, a real product market fit, a real outcome. Because sitting here as a representative of a team, we see all these things, and you're right. You have this position where you don't want to put that at risk. You have all these fans; they're avid, so why kind of change that? But if you're trying to move forward and solve these problems that you see on the horizon, being laser focused on that product and how it fits and how it solves that problem is huge. It's the key to this space continuing to develop, because you really you got to come convince me that it makes sense to go to my owner and say, you should put your money or your brand behind this platform, this product, whatever it may be. And that's not an easy thing to do, right? I mean, these are very closely protected brands and as an industry. So I think that's just a piece of our takeaway.
Probably one of the best pieces of advice I ever got as an entrepreneur is stay focused. Because when we created this ecosphere of wearable tech, my thought was always, if Apple came out with a sports product, what would it be like? It's got to be discreet and user-friendly and easy to use. And we had all these neat things, but at the end of the day, when you launch a product, you got to be laser focused. And so we picked measuring vertical jump, and that's what we focused on. It was very, very difficult to do, and we did it. And it was all about making a product that's super discreet, super easy to use. You just turn it on and go, and have this real-time data. And I think that's a great point of being focused.
And I think you could take advantage of sport as well without actually having to sell to the teams or the leagues. I mean, we actually I was going to say we haven't really invested that aggressively in pure sports startups, but we were the early stage investor in Twitter and Snapchat and Instagram, which have benefited tremendously from their association with sport, even on an unofficial basis, because it led to those aggregations of users, that incredible engagement and passion that helped drive the underlying service to even greater heights. So I think there's a lot of angles into this one.
I want to build off that because there's a thing called lateral innovation that already exists in other industries, and you bring it into this industry. And this is one of the, I always want disruptive new, technological innovation. Yet this lateral innovation, you bring things in. And I remember meeting the guys who later became FanDuel. And they were just these crazy guys in Edinburgh at a place called Informatics Ventures up there. And they were doing something that was wildly illegal. But they were just like super determined entrepreneurs. They didn't understand American football or anything, to your point. They just had this idea that this could be applied because there was a lot of data and there was a big spend going on. And to your point, they were remarkably disciplined. And to your question now that I remembered a long time ago, you say, what characteristics does an entrepreneur have? That's not the right question. There's a myth that it's individuals that are successful entrepreneurs, and the data shows very clearly entrepreneurship is a team sport. And when you look at successful, my VC colleagues here will probably back this up, but if they don't, they're wrong. But the data shows that the successful entrepreneurs are the ones who form teams and understand the discipline of it. It's almost like, well, look at Mark Zuckerberg, he's an individual. Well, Mark Zuckerberg's like saying, I want to be a basketball player, therefore I'm going to be like LeBron James. There's one LeBron James and there's one Mark Zuckerberg. You want to increase your odds of being successful, you're disciplined, you figure out how to build a team, and then to implement the process successfully as you go through
I want to point out the right question is a question that elicits a good answer. As that was. If you have a good team, you have discipline, you have an idea, you're innovative, but you don't have any sales, much less profits yet, how do investors determine where your line with so few dots is headed in the future? I've heard about the toothbrush test, right, where Larry Page of Google said the key test is whether you use something once or twice a day and it makes your life better. That's pretty far from analytics in terms of determining what makes it for a good investment. Mitch, you want to talk about that?
It's so hard. I think it's a little bit like the Justice Douglas test for pornography. It's kind of it when you see it, essentially. But it's really this triangle of leader or team, to your point, of market and of product. And you're really looking for some kind of synergy that makes those three things greater than the sum of their parts. And it's very rare. I think one of the most remarkable things that I've learned in the 9 years that I've been doing this job, having come from the entrepreneurial side, is just how unusual that alchemy really is. And so I think we train ourselves and we push ourselves and our partners to really make sure that we test each of those prongs of the stool to make sure that it's sturdy before we really throw a lot of money behind them, because it's very easy for one fault in there, a great entrepreneur can't solve a bad market. A great product with bad execution isn't going to succeed. So it's really all of those factors.
I think those three prongs are exactly right. And to your point, a lot of early stage businesses maybe have one of the three, and so it's kind of the investor's job to figure out what those others could look like over time. And that's quite frankly why the returns that investors at that stage of the business require are so big, right? Because there's a lot of risk in executing those three prongs. And you can identify a team, you think the product makes sense and the market seems to be there, but they're not all there at that moment when there's just a couple dots on the line, right? So it's our job to try to figure out where we think that's going, and it's in a lot of ways more art than science at that stage with those companies.
But Peter, sorry. I just want to make a comment, and I love you, man, but I'm from New York, so I'm very argumentative, if you can't tell. What the venture capitalist thinks is a good deal may not be the only good deal. Venture capitalists wouldn't have invested in Walmart. And how did that turn out, right? Venture capitalists look for a certain deal that's either going to fail or be very, very successful. That's a certain type of deal, and it's a great deal, and it's powered the U.S. economy in a lot of ways. But there are other deals, like the bat company, which might not be a big, huge hit. It might take a long time, like we're just talking about, owning the Red Sox. It took a long time. That's not a VC deal. And I think that we have to be careful here that we don't just say those are the only good investments for the industry, because they aren't. I
think that's right. I mean, I think the media's tendency to conflate like the Silicon Valley venture environment with entrepreneurship is fucking absurd, right? It's just totally wrong on so many levels. Like, there's so much interesting stuff going on. We're more like, haute couture, looking for kind of runway models than we are like funding American business on a fundamental level. It just so happens that you produce some really spectacular results when you concentrate in the way that we do. But to your point, we're just icing on a big cake.
Amen, brother.
For me, to answer that question, I'll use a recent case study, which was completely art, which was backing drone racing. So we met a guy with a PowerPoint basically 10 months ago who was arguing that drone racing is a thing, and I could take this thing that's happening among hobbyists all over the world and turn it into a true sport, right? So my first hurdle of an investment is, okay, maybe, but what's the size of this potential market? So the deals I like the best in sports have a content component, are not about selling to teams because it's like selling to independent nations, right? So it has a content component that could reach the entire ecosystem of sports fans, number one. Is it compelling, number two? So is there some evidence of early traction? And if it can get through those hurdles, which in the case drone racing, to me at least, did, then the question is, can the CEO really pull it off? Because where I've gotten hurt the most is where I've seen a great idea and I've overlooked or talked my way out of the fact that the person I'm talking to can't sell or doesn't have their act together, or more importantly, has a huge ego and is unlikely to assemble that great team. So in the case of drone racing, I felt that the idea was there, it was scalable, it was compelling from the early videos I was seeing. But more importantly, that the CEO had an MBA from Harvard, which just could have been Sloan too. No preference for Harvard, but had an MBA from Harvard.
Can he overcome that?
Yeah,
Do you think he could overcome that?
I think he can. With time and patience, yes.
There's a negative you could deal with.
Had been a CMO at Tough Mudder, so understands what it takes to make money in this industry, had a film background, had produced TV, so he had the left brain, right brain thing, and had evidence in his life of failing and iterating, which to me is so important, right? Every CEO, including myself, has had to iterate constantly, and you have to have the humility and the grit to go ahead and do that. So I guess it goes to your answer. You know when you see it, but there's some alchemy behind it.
Does it matter at all if athletes themselves are interested in investing? I know that Carmelo Anthony and Steve Nash have their own funds, and I think when SeatGeek sought funding, Peyton and Eli Manning and Shane Battier were all reportedly interested in investing. Is there anything to the idea that smart athletes might know where there's money to be made in sports, or is that just a celebrity thing?
I think it depends, in my opinion, on the motivation for why the athlete is involved. My first bias, because I've seen this play before, is an entrepreneur at a company will want to include an athlete or a sports figure, former commissioner, as a way to give the imprimatur endorsement, right? So if that's the case, that makes no sense more than any other individual. If it's because the athlete as a person is innovative, insightful, puts the time and work in like Carmelo does, then that's different because they have a finger on their pulse. But I think there are some athletes who do take that approach, but I would look for that passion first. Mm-hmm.
I would say absolutely not, because no,
Or differently put.
Because what's the track record of athletes investing? I mean, it's not very good at all, right? So first of all, but that being said, now that I've made the outrageous statement, is if you told me, Steph...
Wait. I'm not sure we know what the track record of a subset of athletes who have a couple of $100 million to invest in startups is, as opposed to athletes who went home, bought a beer distributorship, and really weren't that interested in managing it.
Right.
You know
So
what I mean?
the track record of data that we have, which is that athletes go broke often despite having made millions of dollars shortly thereafter. You know, it's on ESPN. Have you heard of this place? But they show how they've gone bankrupt. So I would say, first of all, my first response would be it doesn't. But on the other hand, to the point that you're making, actually, is that if you told me Steph Curry was involved with something that was doing content now, that's actually very, very interesting because that's bringing some value. And he's putting money in, which means he has commitment to it. If it is specific value like that, then that's a difference maker. But if it's trying to say that because, you know, athlete XYZ invested, it's like the Good Housekeeping seal of Benchmark investing in it, my personal favorite venture capital firm that's sitting next to me right now. But there's a certain tier one investor that invests in the VC world, and if they invest, it's a seal of approval. If LeBron James invests, that's not a seal of approval that they've gone through the diligence process, because they have a track record that's totally different. But to the point is that my well-dressed friend here has brought up, is if Steph Curry invests and it's a content business, that's real value. But the good housekeeping seal of approval.
Yeah, I mean, it's kind of, like for us, it doesn't really matter to me, right? If it's the company's decision to look at their cap table and figure out who are going to be good partners, right? And I think that's the gating item that you need to be focused on is, are the Dodgers, is RSC, benchmark, who's going to be the most, there's a lot of money, we talked about this earlier, like there's a lot of green money flying all over the place in this industry. So who's the right money to take, right? And that could be an athlete, if it's Steph Curry in that example. It could be the Dodgers, it could be, I don't know who it is, it's company specific, and you really just kind of step back and look at who's bringing what to the table, what do I need, what's my goal as a business, and you focus that way. I don't think I'd paint all athletes with one brush one way or the other. It's going to be case by case, athlete by athlete, investor by investor, really, I think is how you'd think about it.
And you also, from an entrepreneur standpoint, you want to really be smart on who you put on your team. Because what you said about the team is, I'm hustle and then I have hack. And in a technology company, you got to have both. And I got a really cool Star Wars collection as well, because I got that nerdy side to me. But when you're building this team, you also want to make sure that the people that are surrounding you, are the right people. And whether that's a sports athlete, maybe, whether that's a certain firm that's really backed by you. We've been really, really picky from day one because we've had this vision. And I think if you do it right, you have this long-term vision. And all you're doing, and things change, and you're always trying to make sure that vision happens. And along that way, you meet amazing people. Our engineers, I got the new Steve Wozniak. He's brilliant. He made everything for our company. And he made it happen, and it was like, hey, can we do this? And you develop this neat stuff. Now, imagine bringing in a person or a company that doesn't understand your vision. And at first, you want the money. Oh, man, we got to get the money, or this isn't going to happen. And so you just bootstrap. You believe in yourself, and you make things happen along the way so you can keep telling the story. Because what I tell everyone is, you got to have a great story to tell. And when you have a great story to tell, you get a lot of great fans. And those fans tell the story for you. There's no better advertising than word-of-mouth advertising. And when you have people that are elite in the industry like we do, Mary Wise is in a panel over here. She drove it through SEC, ESPN, so that we can be the first wearable to be on broadcast on TV. That is amazing. It was one of the dreams I had, and it came true because we had amazing fans that backed it up. But we've never paid for a testimonial, and I think you got to be really careful with the companies you surround yourself with and the people you surround yourself with, because you really want that awesome team to make it happen.
Let's talk about where this technology is pushing these new ideas to intersect with fans. I think that for a while, ticket prices and everything else at stadiums, the cost of everything else, was going up so fast that a lot of money and a lot of energy was being invested in products that were helping fans experience sports at home, in their living room with, HD TV. But I think that technology is actually kind of swung back a little bit the other way, and is now actually, there's a lot of energy flowing into helping fans experience games live. Is that true from what you guys understand? And where do you see fans experience changing or improving the most, like right at this moment?
It's now become common wisdom, but I think virtual reality is real and is a real space, which is opening up a whole new category of product for teams. I don't know how it's going to shake out ultimately, but if you look at NextVR as a case study, and full disclosure, we're an investor, but they've been able to get access to team rights very early in the evolution of a technology. If you look at the history of Twitter and Snapchat and so forth, where sports teams and leagues should have been the first to jump on because they have access to this big audience and probably should have taken positions in Snapchat. They didn't. Virtual reality NextVR has been able to get NBA rights and done a big deal with Fox. It's been able to make traction in soccer.
Just so people know, describe very quickly what they do.
So I barely
If you're
can
a
understand
fan,
it,
how
but
does
as I understand it, NextVR is basically creating the ability for you to sit at home, throw on a pair of goggles, whether they're Samsung or otherwise, and act as if you're standing on the field. So we own the International Champions Cup soccer tournament, and last year we experimented with a game. We did I believe it was a Man United game. And it was as if you were standing on the field and looking left or right, an experience that had otherwise never existed before. So I think there's a lot of tinkering going on. This next virtual reality does feel real, and interestingly, teams and leagues are experimenting with it earlier than I've seen in other technology life cycles. So that's one.
Feels a bit orchestrated to me. So, I mean, I'm long-term bullish on it, on virtual reality. I tend to be suspicious of markets where, unfortunately, where the big companies jump in early, right? Like where the big consumer electronics companies and the big, the sport. In some ways, it's more healthy, I think, when some of the bigger companies follow the smaller
But do
companies.
you think the experience is real? Like
I
from
do.
a fan
I think
standpoint, people
the
would want
experience
it?
is transcendental,
Right,
although
so then sooner or
potentially
later.
nausea-inducing as well. It's like
Wait,
I find when I
nausea-
get hitched virtual reality companies, I like to schedule like a half an hour off afterwards because I'm kind of like. But it is a remarkable experience. Particularly the really high-end experience is just remarkable. But it's got. I think the hype has gotten way out in front of the game on the field.
Oh,
if
and
you
the
will.
danger, it's to your point, it's what we kicked around, should we create a VR fund and jump early? Like, you could end up holding Netscape, which wasn't so bad if you were pre-IPO, but it's so early in the space, it's very easy to back the wrong one. I just think that the experience is fundamentally different from anything we've had before, and I don't know when and how it shakes out, but I think it's real.
Well, esports seems to be another area where technology is just completely changing what it means to be a fan. Are you guys as astonished as I am that there's now hundreds of thousands of people connecting to watch other people play esports?
I was the first investor in Riot Games, which makes League of Legends, which is the most popular esports game in the world. So we kind of saw it early, although I'd love to say we predicted it. We just loved the team and loved the space. It blows my mind. I mean, I've been to the Staples Center for the finals of the League of Legends finals, where they have 15,000 people live and 3 million people live on television, like watching two teams of people play a video game. It blows my mind.
Yeah, I think it's
Everyone's like,
It's content, right? I mean, it's content. It's people have gravitated to it. It's got a following. It's got a fan base. There's content being created. People are engaging with that, and obviously it's taken on a life of its own in a lot of ways. But it's not too dissimilar to the drone racing idea, right? It's kind of a concept that has traction that people like. And if you can build the right infrastructure around it, you can get it distributed broadly and be really successful, like they have it at Riot Games as an example, or just esports in general.
That's one of the great things about our space, though. We're sort of talking about it like past tense, as if it's happened. It's still really early. So the phenomenon has manifested. It's real. 100 million plus unique visitors a month to Twitch, which is absurd. But we're still relatively early. So if we all right here put our heads together and decided to invest in 3 or 4 esports plays, we would be in the first inning rather than the ninth. So that's one of the things I love about our space. Like the trends manifest, but everyone's a little slow to act, because even though $1 billion sounds like a lot of money, it's still not comparative to other industries.
I think it's kind of ironic that 6 old white guys sitting on the stage are talking about, because I guarantee you the people who are playing these games aren't old white guys.
They're 27 and male, and they're
Yeah.
exactly.
And we just can't get inside their head. And one of the first lessons we teach our students is, if you want to start a company, you need to be able to walk in the customer's shoes. And I don't think any of us up here understand those people. We understand them vicariously, and that's never enough to start a company. You have to kind of be of that demographic, psychographic.
Is diversity?
But it's just, I think all of us are shaking our heads saying, it looks like a good business opportunity, but I couldn't understand it. I couldn't start a company in it.
Since you brought up the white guys aspect of this, is diversity a more fundamental problem than just talking about not being able to connect with esports users? Is diversity a fundamental problem in this whole space in terms of who's coming up with ideas, who gets funded, who gets served?
Yeah, it is. I mean, historically, when you look at the data, heterogeneous teams do much better than homogeneous teams because they bring multiple perspectives to it. This has been true for product development as well. Before, there were studies on entrepreneurship, but in entrepreneurship, the work that Ed Roberts has done has shown heterogeneous teams do much, much better.
Since that's true, then why don't heterogeneous teams over time become more numerous and better funded?
Well, one of the problems is, to be blunt, is the funding mechanism is controlled by OWGs, old white guys.
That's true.
What?
It's true, it's changing, but you're right.
I'm not, it just is true. I mean, the data is there. I'm not trying to make a moralistic statement here. I am an old white guy myself. But it is dominated, and it's hard for someone who's not in that group to get money from that group. It just is. Now, we try to, we, representing all old white guys, we try to be sympathetic and understand and invest in them because we think it's a good opportunity. But it's just not, it's not as natural.
Let's talk about daily fantasy. Well, if you have more questions, submit them and we'll ask more questions. As a not entirely old white guy, I think that's on point. If you guys want to ask any questions, yeah. Just to be clear. the left shoe. I mean, do you want to explore that more? I mean, we talked a few minutes ago about how VC funding isn't the whole spectrum of funding for people looking to start businesses, and maybe overrepresented in media accounts like, I don't know, Shark Tank, and also how it's not easy for people who aren't old white guys to get funding. So if I were younger, or if somebody were not white or not a guy, where would they go with a good idea? Would they stand a better chance?
I think actually, as it pertains to sports and tech, there's a bias towards young more than as a bias, right? You want to see the young Red Bull drinking, Mark Zuckerberg hoodie wearing type come in the door. I'd actually like to see more male-female gender diversity among the pitches I get. Most of them tend to be all men. Not entirely why that's true, except for the obvious. But I tend to look for companies to invest in that have more balance in that regard too, as opposed to a couple fans who came together, but really the kind of diversity you would expect to see among a startup team in any category, right? Which would include gender diversity, but we see a lot of just all men pitches.
Do you think it requires a break from credentialism in order to get a broader range of ideas? I mean, you mentioned before someone who came to you with an idea who had an MBA from Harvard and had experience in this place. I mean, does it require a look towards people with more non-traditional backgrounds, or does it require more young and more diverse people to get MBAs?
I don't know how you feel, but I'm not shutting the door just to anybody just because they don't have an MBA or they didn't go to a great school. So that filter's not at work, and not because of some high-minded principle, but just because I'm looking for great ideas.
We
right?
fund dropouts all the time.
Right, I was going to say,
it
it really doesn't matter.
And I think we fund young people super disproportionately to funding old people. So I mean, I think that may be actually another problem.
Yeah,
but I
think that's a really good point. The point here is that entrepreneurship is actually much more like pickup basketball, where credentials don't matter. We don't care who your mommy or daddy are. No, it's either do you get the job done or do you not get the job done.
We can hire credentialed people to support you, but we can't replace that spark that you have.
Well, speaking of young guys with a spark, I want to talk about for a few minutes. I want to talk about fantasy, especially daily fantasy. It seems like that nobody had come up with a way to make continuous money off of fantasy sports before the idea of daily fantasy popped up. Now, I know there are obvious legal challenges. There's also questions about how fast these companies are burning through money through advertising and marketing, acquiring customers. On the other hand, daily fantasy has proven to be a way where people will stick with paying for fantasy over the course of a whole year or years. So when you guys look at daily fantasy companies, what do you think?
We've been looking at, we looked at fantasy for a decade before this phenomenon, and it was impossible to invest in because it had all of the problems of sort of the sports business inherent in it, which was, you had this narrow window of like 30 days in advance of the season when you could actually attract customers, and if you didn't get them then, you could have to wait a year to get them again. In some ways, it's similar to selling ed tech in a weird way, where like you have to get people at the beginning of the semester, you don't get them for the whole rest of the year. So it was something we had continuously looked at, but we always felt like the big media companies were in the best position to do it. The great innovation of these companies was to bust that sort of temporal dynamic of fantasy, and which allowed them to do what you said, this continuous customer acquisition. And there was an incredible appetite for it. But again, to the flip side of it, and this is something that's worth thinking about with the sports business, they kind of ran into the regulatory buzzsaw to a certain extent, and that's really kind of slowed them way down. There was a period in the fall, late summer, where you couldn't watch a sporting event on television without seeing an ad from one or the other of the two leading companies at every ad break. Just sort of anecdotally, those companies were spending hundreds of millions of dollars in customer acquisition, which clearly meant that they were making many more hundreds of millions of dollars in revenue. So I think in some ways it's the whole Shakespearean drama of investing in sports kind of encapsulated, and I think it's fascinating.
I met with both the FanDuel and DraftKings around the $10 million round phase, right? So take everything with a grain of salt, because I passed on it, and there were moments when I regretted it. But the reason that we passed largely was the issue that we're encountering now. I mean, they're predicated on a loophole, and lots of times loopholes are meant to be closed. There's a reason, there's a name for it, right, called a loophole. So we couldn't quite get comfortable around the fact that wouldn't be under threat at some point. And I don't know how it ends, but those kinds of businesses make me nervous.
Yeah, well, it was a loophole at the beginning that they saw before anybody else. And now people realize that, and how replicatable is that? They rushed through it very, very effectively, and they were very disciplined. But I think the one interesting thing...
Do you think the loophole is closed
well, everybody knows it now. Everybody knows it, yeah. So the loophole technically is still there, but now people realize how valuable that loophole is. And just like we were saying before, everyone's crowding around it. You got a lot of lawyers and the whole 9 yards. They realize how much it would be impossible to do it again.
Do they survive, you think?
Well, I think the interesting thing here is that it's like the quantified self. There's so much data out there for sports now that how you massage that and how you kind of use that, there's a market there. And there are people from MIT who are writing these incredibly complex algorithms to try to figure things out. And they're the ones, by the way, who are making the money on these fantasy sites. It's not Joe Better. It's these professional people who have algorithms who, in fact, aren't even athletes, when you see them. They just have a very good algorithm to figure it out. So my point is there's this mega trend with all this data out there that we now collect. How are you going to use that data to make decisions, whether it's fantasy sports or something else? But there's something there.
I'll put a little spin on it. So we have a wearable product. We have a broadcast architecture for wearables, so then you can engage with fans in real time and on jumbotrons and on broadcast. But my end goal, I hate to say it, but I don't care about the wearable. And the engagement on fans with broadcast is our awareness of our technology and what we're doing. And that's great, but what I care about is the engagement with the viewers in the stadium. It's not the 20 people wearing the technology, it's the 20,000 or more in the stadium, and then it's also the 2 million at home watching it. And that's where the fantasy stuff comes into play that I'm excited about what we're building. Because I'm looking forward, and hopefully it'll be next year, where March Madness starts and a team playing basketball jumps up in the air. And people in Vegas are betting on how high that vertical was, and it was 41.2 on the tip-off. But it's in the fans in the stadium, they're all engaged with our app, and they're doing fun things that have nothing to do with laws, but it's all tied in with sponsors, so it creates that interactivity within the event. And there's also connectivity with broadcast entities that make it valuable on the outside. So we're trying to bridge that entire gap, and it's always been our bigger vision.
So if the opportunity exists for fans to engage with that kind of activity, even sponsors, and we're in an overall environment that's shifting towards more powerful entities favoring the legalization of gambling in some form. You have leagues whose commissioners have testified for years and years against allowing any form of legalized gambling, who the past couple of years allowed their owners to take equity stakes in daily fantasy companies, right? If all of that's true, then don't you think, this is what really intrigues me, aren't the leagues sooner or later going to want either to control this or want their cut of it or to be involved directly in it? Isn't that, if it's legal, is that where we're headed?
If it's legal, but then look at what happened with the secondary market in ticketing, right? Which was a constant struggle between the teams and the aggregators for a decade. So I'm not so sure that it's that simple, but I personally think it probably should be legal. But I'm not sure it should necessarily be controlled by the teams.
Well, let me ask Tucker about that. Do you think teams and leagues have learned their lesson from being so slow to adapt to companies and allowing companies like StubHub to basically control the market for their own tickets?
Yeah, I think there's a ton of learnings there. I think it's a great thing that the leagues jumped in with daily fantasy. We're very, I don't want to speak for it. I'm very supportive. I think it'll work its way through. I don't know who exactly out there wants to kill it. I don't kind of understand that end of the argument. I get that there's kind of loophole closing and those types of regulatory environment dynamics, but to your point, I mean, it elevates engagement for us, right? It brings more eyeballs to our sport, to our industry, and that's better for everybody, in my opinion, and fans demand it. I mean, the only reason you see all those ads is because they can pay for them because people are playing the games and they're doing those types of things, and people have believed in that vision. So I think it's great. I think the league should be using their platform, teams should be using their platform. It's kind of what we're doing, and RSC is done to go help those types of things elevate and progress and grow, because it builds our industry. It builds the activity around it. It builds the engagement, the avidity of fans. They care more. They engage longer. That translates to sponsors. It translates to the entire ecosystem. So,
and as someone who works for a team, you see the fan's interest as the fan lined up with the fan's interest, lined up perfectly with the fan's interest as like a daily fantasy consumer?
I'm not sure if those are directly linear, but I do know that if the fan has Clayton Kershaw on his daily fantasy team, he's more likely to watch my game to see how that plays out in an individual day. And I think that dynamic is important at a league level. And again, one player to one team is probably not quite that linear, but at a league level, if people are engaged with our sport and on a daily basis making decisions about who they're going to put on their team, how they're going to perform, and what happened yesterday, what happened last week, those are all positives that I think elevate what we're trying to do.
Just at one point, similar to this, but slightly different direction. I think every league has experimented with the idea of trying to take equity in some type of emerging technology inside their sport or an emerging business. And these are always kind of fits and starts, half in, half out, sort of pseudo VC, where the real opportunity is something we talked about before, that you have this engaged fan base, that you're hundreds of millions of people that you're in a one-to-one relationship with that really care about what you have to say and what you do. There are these nascent consumer-facing properties and brands like Snapchat and Pinterest that leagues could leverage their position to go in. I don't mean, $10 million round, but $500 million round, where you could take a significant stake and use that engagement to go ahead and take that company to another level. And there's been great missed opportunities over the last few years. I'd say Pinterest is one, Snapchat was another. That to me is a huge untapped, opportunity that leagues for some reason don't take advantage of because they're waiting always for the spaces to sort of shake out, right? They don't want to be too early because God forbid we pick the wrong one. But if I ran an entire league like the NFL, I would take risks, and I would have been taking 10% of Snapchat at a $1 billion valuation.
And the point of that is investment doesn't mean endorsement. It means I'm taking an option out on it. That's very important to understand. That if someone invests in something, if I'm the owner of the LA Dodgers, I make an investment in something, I have an option. That doesn't mean I endorse it. So if it goes really well, I'll do it. The core business still is baseball customer experience.
That's interesting. I think that traditionally leagues and commissioners, the public faces of leagues, might not have put that idea forward so plainly. But I think that's obviously where we're at now. We only have a few minutes left. I want to ask you guys a question that came from the audience. which is interesting. What chances is that we're in a big bubble? That sports spending on sports, whether by consumers or businesses, is just not sustainable at this crazy pace it's been going.
You're the real VC.
Yeah, so we're nowhere near a bubble relative to, energy was a bubble where you had, everyone's investing in clean energy and they didn't understand what they were doing. There's this enormous rush into it. In sports, there are enough good things going for it, and it's not so out of control that we're in a bubble. There are enough good things. We talked about the cautions so that people don't go in here. But there's a lot of good to be had here. It's applying technology to a business where there's an enormous amount of spend that stays there whether the economy goes up or down. It's not dependent on the price of oil, for instance. It's not cyclic. So I think overall this is a good business, but it might overshoot it a little bit, but it's not anything like what we've seen the other. You're not going to see a crash here.
I don't know if I'm qualified from a macro market level to really comment, but I think one thing you got to think about is where we're starting, right? All this activity started from a pretty low level, in terms of innovation and technology. So the activity, I think, hasn't gotten us, even to parity quite yet with other industries. So I don't think there's a bubble, and I think that's why we spent a lot of time focused on, each individual company and what the product is, and obviously there are valuation dynamics when the industry starts, getting hot like this one has recently. But I think that's where discipline comes into play, and really focused on the individual companies and let the rest of that market noise kind of play itself out. But as long as you're focused on your strategy and where you're deploying dollars, your brand, your time and resource, I think you can live through any of those macro.
I can also say there's no question, there's no bubble related to innovation. Every single sports team needs to innovate. Whether there's a bubble relative to startup companies, that's a question. Should LA Dodgers run an incubator accelerator? The question is absolutely, because they need to get that idea flow. They need to understand what's going on, and that will help their core business be successful. Whether those startups make money, that's another question.
I think the sports thing is the opposite of a bubble in some weird way, in the sense that a bubble really means when valuations separate from reality to a certain extent. Right. And we have totally not seen that. I mean, look, every day I get pitched, the Uber of massages or some bullshit. I mean, that's a bubble. Right, like that's and then they insist on having a $40 million Series A at a $150 million pre. That's a bubble, right? Sports is not in a bubble. There's still a lot of room for value.
It had a Tinder component to that Uber with the Airbnb thrown in as well.
Well, we have a kind of a unique perspective. Gary Vaynerchuk is my partner in another business. So we own a company called VaynerMedia, but we also have a early stage fund, $25 million fund with a pretty big portfolio. So in that space, and then I will see companies say, how on earth did you get funded, and how'd you get funded at that level? Putting on my other hat in the sports space, I'm not seeing silly valuations. I'm not seeing people get funded who shouldn't get funded. I just don't see it.
I agree. I would agree, especially with Mitch said, it's just the opposite of a bubble. I mean, I've been following this for 20 years on the wearable side and the fan engagement side. And so in the last, 3 years, it's been fun to see all these companies come in. Now the question is, are they going to make it, right? And so you want to make sure that you're well capitalized. You want to make sure, that's why I said bootstrap at the beginning. When the things get serious, you slowly climb that ladder, surround yourself with the right partners. And I think it's that exciting time actually with sports and engagement and things like that, where it's just at the beginning, it's at the beginning stage of it. That's how I look at it.
So not only are those all good lessons, but it's a good lesson that you should always wait till the end of a panel before you leave, because it was at 2:14 that we got to Uber for massages with a Tinder component. So
The crap delivery was the high point.
The crap delivery was the feces focus was something I hope you will all go write case studies about. Thank you. So thank you all for coming, and thank you very much to our panelists.